What are index funds and why should you invest in them? Let's take a look. All right. In my last video, I said I love target date funds. So which is it? Well, target date funds actually use index funds, so it's really important to understand them. Index funds track an index of stocks. An index is simply a collection of stocks grouped together. A couple examples are the S&P 500 and the NASDAQ, but there are many examples of different indexes. So why do I love index funds? Well, they're diversified, usually, low cost, and passively managed. The passively managed part is really important. There's not a person or a company trying to pick stocks and jump in and out of the market. Index funds simply invest in all of the companies within that index. This is why it's low cost. There's no one managing the fund, which is what most mutual funds do. Not all index funds are widely diversified. Some are actually very concentrated. For example, there are some that only track a certain sector or have a theme, such as healthcare companies or small cap value stocks. So what index should you invest in? Well, it depends on your strategy, but I love the US total stock market. It has about 3,700 companies within that index, so it's very diversified and low cost. If you want a little exposure outside of the US, that's not a bad idea. A total world stock market index fund would have about 10,000 companies from all over the world, but about 60% of the assets would still be from the US. So why would you invest directly into index funds instead of target date funds when target date funds actually use index funds? Well, for starters, the fees in index funds are slightly cheaper than in target date funds, but the big difference is exposure to bonds and fixed income as you get close to that target date. Target date funds will get progressively more conservative as you approach that target date. Index funds, on the other hand, will always be comprised of whatever index it is that you choose. So for example, if you choose an S&P 500 index fund, that fund will always have 100% stocks in the S&P 500. This means the index fund will perform slightly better over time than a target date fund because it has more exposure to stocks over time. However, it will be more volatile. It all depends on your strategy and if you are comfortable with having potentially rather large swings in your retirement account. You pay for higher returns by having slightly higher risk. Let me know what your favorite index fund is in the comments. This is Eric, the Teacher Money Coach, helping you take control of your money.